So there are times when we tackle more nuanced or complex portfolio issues when we speak at events. Recently, I gave a speech where I really wanted to kiss, not you, Brennan, sorry. I wanted to keep it simple, stupid. Often I find that when speaking with average investors, analysts, or pundits are often overcomplicated. They overcomplicate investing or the portfolio building process and present information that is just not useful to the average investor, even sophisticated investors at times. So I really wanted to look at the basic ideas behind the structure of an average Canadian stock portfolio and show two major mistakes we see every day. For me, it really starts right at conception and really involves just poor structure. Now, what I'm going to look at here essentially is investors often come to Keystone because they are dissatisfied with their returns and want a better option. I can break down the most dissatisfied groups of investors into two broad groups using two common strategies. Again, this is if you're trying to beat the market. Most Canadians either employ a strategy called what we call mass diversification, that is the traditional big bank model, or they go it alone. Let's focus on group one first and why the strategy is really not working. Number one, this are those who have poorly constructed traditional big bank stock portfolios. These portfolios are typically composed of 5 to 10 mutual funds or 5 to 20 mutual funds or ETFs, each owning 100 plus stocks, so they own the market. It's all in the name of that magical word, diversification. The problem is that while diversification is useful in its application in modern portfolio building, it has become executed terribly. It's a good idea, but poor execution. As opposed to this guy here, where it's just bad ideas and even worse execution. Ha ha ha. Well, he definitely cannot balance a budget, on a positive note. As he has shown us, he can definitely balance himself, and we're all so impressed by that. Now, with this example of horrid execution in mind, I refer to a chart on optimal diversification or optimal portfolio diversification, which displays that by owning 20 reasonably diverse stocks, you have already achieved optimal diversification. And yet, by using a big bank method, investors often own over 1,000 stocks. This is poor execution, and we see it on a daily basis. This is what we like to call, wait for it, boom, diversification. Again, I think that gets funnier the more I use it, doesn't it? Now, back to our slide on traditional big bank mass diversification. With this strategy, all you achieve is a complex, fee-heavy portfolio that mirrors the market but underperforms due to those high fees. So let's look at number two, the second portfolio that we often see in unsatisfied investors. This is when you choose to go it alone. By chasing returns, they often end up with too much risk. These portfolios often consist of concept stocks, pre-revenue stocks, or junior exploration stocks, particularly in Western Canada. These portfolios, if we can even call them at all, are poorly structured with either too little or far too many stocks and are subject to impulse or panic buying and selling. They often take undue risk in misguided attempts to find blue sky type investments. Most often, this strategy will end in disaster. Now, you don't have to take on undue risk to build a portfolio that has a fighting chance to create real wealth. If you want to build true wealth, we want you to chase cash flow, not concepts. And in the building, less is more. Concentrate on quality over quantity. What we advise you to do is take control of your portfolio. If you want to beat the market, you cannot just be the market with a big bank portfolio where you're owning 500 to 1,000 plus stocks through a mutual fund or ETF portfolio. You can create your own simple equity portfolio. Use a strategy that we call and have coined focused diversification. You're building a 15 to 25 stock portfolio gradually over a 12 to 24 month period. What this does, it reduces risk to short-term market corrections, and it'll provide flexibility to add to new positions as new opportunities come available. We were talking earlier in the podcast, when we do a sweep of, say, 3,000 companies in the US, we'll probably pick out 20 names. We may recommend 3 of those, but we're monitoring those other 17 for potential entry points during the year. If they come in that range, they can become a buy. So you have some dry powder available to add those companies. The process. So if you wanted to use our service or you wanted to start constructing your own portfolio today, starting with 3 initial positions, that's just 3 to 5 initial buys, and adding 2 to 3 stocks per quarter as new research or information is released. You don't always have to buy a full position in the companies that you're adding to your portfolio. Let's just use some broad numbers to explain that. Say if you had $100,000 and you were going to buy 10 stocks, you take 100,000 divided by 10. A full position then would be 10,000 in each stock. You could buy a half position, that would be 5,000, and then add as you go over time. So those are ways to layer in to individual investments or stocks as you go.